Hello, and welcome to the IRE.IQ Quarterly Fundraising Report review. Thank you for joining us for a look at closed-end real estate fundraising activity as tracked by our IRE.IQ database. We will be sharing some trends and data covered by our Q4 2025 IRE.IQ Fundraising Report, which was published last Thursday, February 12th. Today, I will be joined by a pair of industry experts to discuss the broader trends affecting real estate fundraising and where the market might be headed. I'll share a brief slide presentation with data and charts from the IRE.IQ fundraising report, and then we will have a broader conversation about fundraising. We also will be answering questions from the audience through the Q&A feature, which you can access at the bottom of the screen. All the data discussed in the program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts, and it has tracked more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IRE.IQ as part of their benefits package. But if you are not a sponsor and interested in using IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. Now I'd like to welcome our panelists, Elizabeth Bell of Hamilton Lane and Mark Fitzgerald of Affinius. Hi, Liz. Hi, Mark. Thanks for joining us. Really excited to do this today. First of all, I would love to just maybe see if we could start with each of you giving kind of a brief overview of your role, where you sit in the fundraising ecosystem, and the perspective that gives you on the market. And I'll start with you, Liz.
Great. Well, thanks, Loretta, for having me here. I'm very excited for today's presentation. So I'm Liz Bell, co-head of real estate at Hamilton Lane. Hamilton Lane is a $1 trillion private markets firm. Within real estate, we oversee and manage over 100 billion of assets, so have a lot of data at our fingertips. We invest heavily through primary funds commitments, and I think that's probably most relevant to today's conversation. We also invest in real estate through transactions, be it co-invest, secondary, some JVs.
And Mark.
Great. Thanks, Loretta. Happy Tuesday, and thanks for having me. My name is Mark Fitzgerald. I head up research here at Affinius Capital. We manage approximately 60 billion of gross AUM and invest across the risk spectrum and capital stack in both North America and Europe, and have offices globally in these regions as well as Asia and Australia. So I think that really gives us a perspective on the global investor market and playing across the risk spectrum and the capital stack in various strategies, which is central to identifying where we see relative value from a risk return perspective at various points in the cycle. And so in research, my role is to work closely with our executive teams and portfolio managers to help identify those opportunities and also help to communicate and articulate those strategies to our existing and prospective investors.
All right. Again, thank you both for joining us. I'm excited to, go over some of the data we've collected here and kind of see how you kind of react and how that matches up with what you're seeing. So I'm going to start by sharing a presentation. And hopefully everyone can see this. So just a note that today we're going to be looking at closed-end funds investing in direct properties, equity, or real estate debt. For this current report, we're sharing data on funds with a final close between October 1st, 2025 and December 31st, 2025. And it's really important to remember that this is a snapshot in time. Additional funds may have closed but haven't announced yet. Our IRE.IQ team learns about fund closings continuously as the year goes by, and we update our data accordingly. But I do think the overall trends that we see here can be still useful, even if it's a little, the precise number is sometimes shifts a little, but the trends do hold steady, and they are useful to indicate what's happening in the market, give some guidance to investors, managers about where we are headed. And just a final reminder to the audience, we are taking questions throughout. Just use the Q&A feature at the bottom of the screen. I have an IRE.IQ colleague on the call. He can answer some of the more technical questions about the data set, in writing, and I'll pose the broader questions to our panelists to get their insights. So let's start with slide number 1. This is closed-end real estate fundraising. And we found $33 billion raised by 29 funds holding a final close in the fourth quarter. This follows 22 billion raised by 29 funds in Q3, 30 billion raised by 30 funds in Q2, and 67 billion raised by 31 funds in Q1. Overall, in 2025, we tracked so far 119 real estate funds to hold a final close with aggregate equity of 151.5 billion. That is 2/3 more than the full year total in 2024, which was the lowest annual total in a decade. I don't think we'd seen anything that low since 2014. With all that said, does this more or less match what you're seeing in the market? And I'll start with you, Liz, because you actually raised an interesting point in our prep call.
I would say that the numbers for 2025 are a little light compared to what we're tracking. But I think we talked about this. I asked, are pure play data center funds included in your data? Because that was a sizable amount, at least in our data for 2025. And so I think that could be the delta between the numbers we're seeing and what you're seeing.
Yeah, and we are tracking some data center funds in this real estate data set, but we are also tracking some of it in our infrastructure data set, which is a separate report which we release and comes out of our infrastructure database, which is only available right now to i3 subscribers versus this IRE.IQ product, which is real estate. And I guess this kind of maybe leads into a question. Maybe before we get too far, I'll be willing to get a little in the weeds. Liz, what do you think is that distinction between real estate and infrastructure, and what's guiding when it comes to data centers, and what's kind of guiding your classifications that might be different than ours?
Yeah, we have a large infrastructure team and an investment group here at Hamilton Lane. So we're constantly looking at some of the strategies that straddle both real estate and infra to determine where it's labeled. Typically for data centers, if there's an operational component to it, we'll put it within the infrastructure side. If it's really a strategy where you're, building, powered shells, turnkey, that usually falls within real estate. It's interesting. I went back in between the prep and now to look at some of the funds that I thought would be a question, and I think some of them may actually name themselves as infra, even though we still put them in the real estate bucket. So I have the feeling that could be where we're seeing a little bit of a difference.
Yeah. Well, and I think, the blurred line between real estate and infrastructure, especially around data centers, continues to be sort of a major theme. Mark, is that anything that you have struggled with at Affinius?
Yeah, I mean, it's certainly a question that we have received from the investor community, and I think largely would agree with Liz's assessment in terms of how that's delineated. Although I think it's increasingly challenging to kind of separate the two, given the importance of energy in the space today, and given what's going on in the sector. So,
what kind of an outlook do you have? So this is, of course, backward looking at what we tracked in the year, looking backward. What kind of an outlook do you have for fundraising in the year ahead? I've heard, some people pretty excited, feeling a lot of green shoots coming into 26. Other people a little concerned about sort of the economic situation. I'll start with you, Mark. What kind of sense or outlook do you have for real estate fundraising in the year ahead? Do you expect it to be similar to 2025, higher, lower?
yeah, I mean, I think if we maybe take the chart's excellent. I think if we go up a level to the annual trend, I think that's pretty consistent with what we have seen recently, where I think you have 152 billion raised in 2025, which was up about 50% year over year from 2024. So I think that, and higher than 23 as well. So I think the positive momentum is certainly something that we are seeing in terms of investor interest and activity. And I think our expectation is that is going to continue. Part of the reason for that, I think we see improving investor balance sheets, if you will, as it relates to, they were challenged for a few years with the Dominator effect when the bond markets fell in 2022 and equity markets as well. So it took real estate a bit longer to correct. I think we now see that on a relative basis, much of the investor community is actually underallocated to real estate. And given the challenges in recycling capital over the past couple of years. I think underallocated certainly to certain strategies within the real estate sector where they would like to change. And if we look at kind of the 30,000 foot view for from a valuation perspective, I think we've published a couple of papers recently that have focused, a lot of focus has been on why our cap rate spreads and appraisal cap rate spreads continue to be so tight to particularly to investment grade fixed income strategies. I think, part of that tightness can be explained by the historical relationship between real estate and inflation relative to fixed income. And we have, if it's hard to get a perfect measure of what is inflation going to be on a go-forward basis, but there's a pretty strong historical correlation with real estate performance and inflation, and also with cap rate spreads relative to either inflation survey expectations or recent experienced inflation. And so if you look at the survey data on a go-forward 1 or 2 year basis, the expectation for many investors is that inflation is going to be about 100 basis points higher than the average of the last 40 years. And so that, in our view, the tightness of cap rates to traditional investment grade fixed income is somewhat explained by that. And then you also just have, I think, a broader valuation effect where the stock market, the S&P 500 is almost doubled going back to 2022, and real estate's down 25% over the same period in the private markets. And I think that we feel that's offering some more attractive entry points on a relative basis compared to the broader asset class picture.
Thanks. Liz, any thoughts here?
I don't want to jump ahead too far. I think starting at the beginning of the year for 2026, I think it was a pretty strong, but people were mostly opportunistic or optimistic that we'd have a good fundraising year. I think Mark touched on this. A lot of our clients were underallocated or had room to grow. Just pure dollars putting out the past few years, they have to put money to work. We encourage our clients not to time vintages, to be consistent in pacing. I think you're starting to see a little bit of the capital flow back in too, which is helping kind of unlock that DPI freeze that we had. So I would say that's encouraging for an outlook at the beginning of the year. I would say in the past 2 weeks, what's been going on with the changes and the acceleration of AI and AI agents, you're seeing this is really impacting broader markets significantly. And just to touch on this, Amazon since the beginning of February is down 18-20% in market cap. That's $450 billion decline in value. So as we sit here at Hamilton Lane and we look at alts generally, and we're always comparing against public markets in that regard, I'm not sure if we're going to see denominator effects going forward. I'm not sure, how some of the asset light alts will be challenged with valuations in the year ahead, given some of this AI disruption. And so as we sit here just today, I would say we might have a denominator effect again hitting us a little bit in 2026. However, I think real estate and even infrastructure should benefit in this environment where these are a hard asset strategy, and the disruption we are seeing from AI on, software companies and getting into a whole host of other areas that could cause a ripple effect. At least we have building, people still need a place to live, right? And so, and not to get, too negative here, but so I think there's two factors at play. I think from a real estate perspective, it's strong fundamentals, and you're starting to see groups allocate again. However, you have to keep that in context of what's going on in the broader world.
Absolutely. I'm gonna move on to the next slide. This is looking at debt as a portion of the overall closed-end real estate fundraising. In Q4, we saw 7 real estate debt funds hold a final close. They raised $11 billion. Q3 only had 2 sort of small funds with a total fundraise of $450 million. But if you look at the full year total, all of 2025, we saw closed-end real estate funds raise $27 billion. And that figure was about $20 billion for the entirety of 2024. So we did still see that sort of increase year over year in the space. I want to start with you, Mark, to maybe kind of get your thoughts on real estate debt fundraising in the current environment. What trends are you seeing right now? And, how is that interacting with some of the other issues that you just raised?
Yeah, I think from a big picture perspective, certainly capital raising in the debt space has been a bright spot over the last couple of years. And I think the opportunities in the capital markets as a result of, some of the challenge vintages in 21 and 22, and also, some cyclical pullback from some of your traditional lenders, as well as, structural as it relates to capital charge shifts going back to the GFC has really created an opportunity for a lot of these debt funds to reposition capital stacks and to, particularly for, I think, transitional bridge type lending as well as construction. There's been increased opportunities the last couple of years, and I think that those strategies have really resonated with the investor community. I think you've also seen some tailwinds as it relates to the insurance sector as well. So in the U.S., given elevated an elevated rate environment over the last few years, and has resulted in more sales of annuities, and that has fueled some of the insurers looking to place capital. I think in vehicles that have attractive capital charges, which I think in many cases real estate debt funds fit into that bucket. And so you've seen that be a very active sector in terms of investment in U.S. debt funds. And I think we're starting to see some of those opportunities emerge as well, given regulatory changes in certain parts of Asia and the rest of the world as it relates to that space. So that has been a positive. And certainly I think you are seeing with the rate decreases going back to the end of last year by the Federal Reserve, I think that has brought more debt capital into the market. So I think it's probably more active, and some of the traditional players have begun to come back and compete in a more meaningful way. But I think we still see that being an area with a lot of opportunity, and certainly has resonated well over the last couple of years.
Certainly within private markets, we've seen a lot of interest over the last couple of years with private credit broadly, not just real estate debt. Has real estate debt struggled to compete against private credit, Liz? What have you sort of seen?
Yeah, private credit has definitely been a little bit more in favor over the past 2, 3 years. But and it's unfortunate because I think a lot of times we see real estate credit funds kind of fall between the cracks a little bit, where a lot of our, especially kind of public pension clients, have strict definitions that you have to invest in real estate equity. And in order to put a real estate credit fund into their allocation, sometimes you have to go up to the board and get approvals because it's deviating from that equity definition. And so they say, okay, it's credit, has to go to our private credit team. And then a lot of the times within private credit, it's just not hitting the return thresholds on a relative basis. So it's falling between the cracks a little bit. And
You
then I
did
have views on just credit in general today.
Well, I want to hear that, but you did just mention the sort of some of the issues around the equity markets that we're seeing. I'm also hearing that there are actually some issues around private credit in these same software companies that I've seen their stocks fall. Could that also, have some ripple effects toward real estate and real estate debt?
I think anything that has, again, thinking about some of these asset-light businesses that are heavily reliant on software programs as their competitive advantage, will struggle with valuations in the near term. And when valuations are uncertain or go down, that clearly has the ripple effects that you're going to see on the banks. So I think there's some, broader financial system implications here. I don't think it's a crisis by any means, but I do think there's going to be a little bit of strain. And so, again, getting back to real estate on a relative basis, I think real estate, these are bricks and mortar. Yes, the demand will be impacted if, depending on how AI impacts the broader economy. But, these valuations should hold up a little bit stronger than some asset light, tech-oriented companies.
Mark, any other thoughts on this before I go to the next slide?
No, I mean, I think that, those concerns that both you and Liz mentioned as it relates to, overall private credit and, certainly the last couple of weeks, but also going back to last fall with, a few companies that, were perceived to potentially be some canaries in the coal mine, I think probably favors real estate, given the asset-backed nature, but certainly was a question we were receiving quite a bit in the latter half of last year as well.
Yeah. I'm going to go on to the next slide, but I just want to remind our audience that we're taking Q&A using the Q&A button. So if you have any questions to ask of our panel, please feel free to sort of just pop those in the Q&A button, and I'll pose them to them. Moving on to the next slide, I just want to touch on this pretty briefly. Average fund size, there were a bunch of mega funds in Q1, so we really saw that tick up. Fell back down in Q3. But here we are in Q4, back to sort of a return to form, over $1 billion for the average fund size. The median fund size in Q4 was also $775 million, and we saw quite a few funds come in above $1 billion. We've been talking about this we talk about this every month or every quarter. What are sort of your expectations around average fund size? Will we continue to see these sort of mega funds dominating the market? What role are they currently playing? And we used to define mega fund as a 1 billion plus, but I think we've really sort of seen that goalpost shift to 2 or even 5 billion. Liz, I'll start with you. Kind of, what's your perspective on fund size and these sort of mega funds in the market?
I have 2 points to make here. The first is when you look at this page, what jumps out at me is that, the number of quarters where $1 billion is the average. And what that says is, to me at least, thinking of some of our clients who are large capital sources and allocators, if they have to write a ticket that's 100 million at a minimum, that's going to preclude them from a lot of funds that are, below $1 billion today. And so I think that's kind of pushing this up a little bit. It's going to be hard for them to go write $100 million check into a $675 million fund. However, I think they can access a lot of those smaller funds through intermediaries or partnerships with other groups. So that can solve that to a degree. I think the other question that you have is kind of this bifurcation we are seeing in the market, where the larger mega funds, especially ones that have significant data and can harness that data, I think will have a competitive advantage going forward. We see it here. Like I said, we manage 100 billion of assets for real estate. We use that data to really, it's phenomenal what we're doing with it now, but you're harnessing it. And in some ways, it's kind of allowing us to go directly to operators more so than we had in the past, because we have this data to see, we know how assets are performing. You still need, and markets are performing, you still need an operator on the ground who knows how to work the real estate, who can tell you which street corner is better, which asset, if you're at a, intersection, you want to own one asset, not the other three at that exact corner. But I think the larger players that have scale, have data, will be able to partner with those operators more effectively. And so I think there is a bit of a lost middle we're seeing, especially from the mid-size allocator funds that don't have that data, can't harness it, can't invest the millions of dollars you need to have, AI really help you with the data. So, I think that'll be interesting to see over the next few years what happens to that space.
Yeah, I have a question I'd like to pose. Do you think there will be a shakeout of managers, of GPs? Is there enough capital available to support all the GPs currently looking to raise funds? I'll let either one of you jump in on that one. Liz?
I do think, as I mentioned, I do think that there are some middle market allocators that have already been hurt a little bit by just not having a competitive advantage or unique strategy. I think what we do see is a lot of single sector operators that know the inside and out, especially if it's a niche sector, that they're getting some capital. And we're seeing a lot of large pension fund or allocators and institutional investors go directly to those operators, kind of bypassing that middle market allocator they used to go to in the past. So, I do think that there are some managers that are going to, go away, but that's the natural cycle, right? Every time real estate cycle happens, you have a shakeout and new entrants emerge to backfill.
Any thoughts, Mark, on the sort of average real estate fund size?
Yeah, I mean, I think I would agree with the vast majority of what Liz is saying. I think we probably expect to continue to see a divergence. Probably part of the reason that we are seeing elevated fund sizes as well is just that there are strategies that have been in favor that benefit from scale. I think Liz's point on being able to harness internal data and data being increasingly important and valuable is certainly something as a researcher that I support, but I think we certainly see that in the marketplace. But I think if you think about the strategies, whether it's credit vehicles, which I think really can benefit from deal flow access and a breadth of opportunities with a diversified lending platform and the certainty of close. So I think that is one reason why credit strategies, may be fueling a bit of that. And then obviously, we've been talking about the challenges in the public markets, but what's happening in terms of the data center market today and increased interest in that sector. When you're talking about individual deals that are $1 billion plus, you really need to have that scale, I think, in many ways to approach the sector. And you see, just even from the Q4 announcements, I think the hyperscalers expected spend on the build out of their digital infrastructure, for 2026. As of Q3, they were projecting about 500 billion. That's been up to about 700 billion for just 2026. So I think the scale of the opportunity in that space is going to require some larger vehicles and also opportunities, I think, for some firms to potentially capitalize on discrepancies or divergences between pricing in the public and the private markets. But the flip side of that, I think Liz's point was very important for those. I think we are potentially also moving in some of the more traditional sectors to a phase of the cycle that's going to be really more focused on asset selection and execution. And this is where some smaller vehicles that can, target niche sectors or, really identify and articulate their competitive advantage or unique strategy can also, begin to differentiate themselves as we hopefully start to see the cycle turning.
I have a question from our audience, and it kind of builds on this topic. So, obviously it makes sense that if the transaction sizes are these mega transactions, that you would need these mega funds to have the scale. But when it comes to sort of the middle list funds, who do you see investing in the lower middle market and middle market transaction sizes? Do you think the mega funds could take that on as well in the future? I don't know. Do you want to jump on that one first and then Mark?
I think it's hard for some of the mega funds to go into kind of the lower middle market. And again, what I said earlier, that middle market segment isn't going away completely. There is a niche, but I think in order to differentiate, you have to produce outsized returns. And all the, LPs can track this. Again, data is becoming more available, so you can see how you're performing relative to your peers. And I think, having strategies, especially where you understand the real estate, you're a little bit more than just an allocator. You can step in if needed to operate, or you just understand some of these niche sectors a little bit better than some of the mega players. I still think there's a role there, and especially with roll-up aggregation strategies, right? That is still a great play, whether you're going at it through kind of a lower middle market fund that's working with operators, maybe you're going directly to operator, but some of the most attractive real estate today, I think, have small check sizes of, $10 to $20 million of equity. The mega funds can't do that. They're never going to do that one-on-one. They'll buy a portfolio of scale. So I think that feeder system is still very much alive.
Mark, anything?
Yeah, I think I would agree. It's all about, how can you differentiate your strategy or your pipeline, whether that's based on track record or partnerships with operators or vertical integration with development teams across the firm. I think it's going to be increasingly imperative that you're able to do that.
Let's take a moment to sort of talk about sort of a global perspective. Over the past 12 months, North American real estate has captured 40% of closed-end real estate fundraising activity, with 19% to Europe and 12% to Asia Pacific. And that's this chart right here, which is the past 12 months. When we look just at Q4, though, 60% of the capital was targeted toward North American real estate, 18% to Europe, 8% to Asia Pacific. The biggest difference, I think, between the full year versus the Q4 is really the presence of the multi-regional fund investors, which is some of these really big opportunity funds. But the past year, whether it's the imposition of tariffs, some of the uncertainty about geopolitics, are we seeing a little bit of a bifurcation maybe around sort of North America or US versus rest of world? What interest are you hearing from investors related to non-US markets? Or what interest are you hearing from international investors toward the US? So kind of both of those cross-border. Mark, I'll start with you on this one.
Sure. I think this may be an example where, at least to date, we are seeing a divergence between what maybe survey data and what people say versus actual actions being taken. So I think what you're seeing here in terms of the outsized capital raised for U.S. and North American based strategies, or at least consistent, I think, with what we've seen over the last several years. Post-Liberation Day, there was a sense that capital might begin to stay closer to domestic markets, or that the U.S. exceptionalism story was perhaps coming to an end. And granted, we have not been in a quote unquote normal capital raising environment over the last couple of years, but I think the indications that we see thus far don't seem to support that story at the macro level. There are certainly examples across the globe of investors who are potentially maybe pulling back from certain areas of the world, but I think even from what we were hearing over the summer, I think that sentiment has become less pronounced in the investment community. And even if we look, there was a great Green Street report that came out last week discussing how sort of this story was not really backed by the data. And overall transaction volumes in the U.S. are up 23% last year and flat in Europe. So I think the divergence has not really shown up yet in the data, although we do hear that sentiment from some pockets of investors, although I'd say the large global players recognize that they're going to continue to be diversified in their strategies.
Liz?
Yeah, we still think the U.S. is the strongest opportunity today. So we're allocating a vast majority of our capital to the U.S. When you look at the underlying fundamentals, supply and demand is mostly in check, given there haven't been a lot of new construction starts the past few years. And so we feel good about the fundamentals. And then what is very interesting today, and we sort of didn't touch on it as much on the debt side, but what we're seeing over the past 6 months, 9 months, is that banks are coming back to the real estate market, which is going to inject liquidity into the system. And they're coming back in a very aggressive way on two fronts. One, on spreads. So spreads are coming in tight, particularly for multifamily and retail, which is interesting. So spreads are compressing there. And then also advance rates are much higher than we thought. And so in some ways, the banks, especially if it's a high quality asset and high quality borrower for the banks, they want to put out money, and they're becoming aggressive, which I think is good to unlock some gridlock in the system here. And so I think with that phenomenon in the US still looks like a very attractive market on a global basis for us.
And while we're here, I have a question from the audience. Why is Asia Pacific investing so light relative relative to North America and Europe. Is it related to the geopolitics because Greater China is the biggest real estate market in Asia, and are people maybe concerned about getting in that?
For us, what we've seen when we look at the three different geographies, call it North America, Europe, Asia, the performance has just been lower on a relative basis for Asia. And so, there's been some funds that outperform, and you really have to be careful about picking the right manager and fund when you do go to Asia. So for us, when you just look at the numbers, it doesn't really make a compelling case, not even on a risk adjusted basis, just kind of comparing the regions. There are some very large Asia funds being raised today by groups that know what they're doing, and they're mostly targeting Japan and Australia. So I think the China question is less relevant. That's much more of a emerging markets question. But there's some very strong developed markets in Asia that are appealing too.
Mark?
Yeah.
Yeah, I mean, I think I would echo that. We have, historically been based out of the U.S. and, have identified some opportunities in Europe that we've attempted to capture over the last 10 to 15 years. But, I think that we just haven't had the expertise or the local market, seen the opportunity really to enter some of those markets in terms of risk-adjusted return basis.
I'm going to take us on to the next slide. Looking at investment style, obviously, and I mean, our audience knows this, when we're talking about just closed-end real estate funds in this data set, and so, you're going to be in the higher return strategies. A lot of the open-end funds, there's very few closed-end core funds. So, that's to be expected in the data. But if we go back, let's say 18 months ago, we saw a pretty even split between value add and opportunistic capital raising. But, in the last 12 months, every time we do this, the opportunistic share has just been growing and growing. Why do you think there might be this bias toward opportunistic funds? Do you think it's just sort of the market cycle and the environment we're in, or is there something else sort of driving that? Why don't I start with you on that, Liz?
I must say this data is a little bit perplexing to me. I think in today's market, our view, well, one, looking at the data that we've seen, value add funds have outperformed opportunistic funds on a relative basis. And so, especially when you layer on the risk you're taking for opportunistic, in the returns, that we track, you're not really getting paid for that additional risk. So that would steer us to focus more on value add segment. I think also in today's market, coming out of the cycle that we were just in, I think you can still access very high quality real estate and achieve strong returns without taking on too much risk. And so for us, when we look at funds or specific deals, we're not swinging for the fences. We don't need to hit high teens 20 IRR. And I just think where we are today, because of the basis reset, and I think now with liquidity in the market again on the debt side, you can get really strong, low to mid-teens returns without taking on, trying to find deep distress or doing a lot of development or going to secondary or, suburban markets you may not want to be in, just to hit that higher return. And so this slide actually kind of, I am a little surprised about. I think some of the data is probably skewed because of the mega funds that we all know are included in that opportunistic category. And that I'm going to think you have to strip that away. But yeah, I was a little surprised by this.
Mark, reactions?
Yeah, I think Liz hit on the head on, the definitions in our industry are far from solid. So, is that opportunistic based on leverage, life cycle, location or sector, et cetera. I think from a return and, data center development being an example, right? Is that classified with a pre-lease as opportunistic or value add? I mean, I think a lot of that could be definitional. But, I do think going to the returns story is, maybe part of this is where we've been, both as an industry and in the cycle. Because I don't think that from an opportunistic perspective, we are seeing huge discounts today or distress at the asset level or property level, and so, or at least not outside of maybe some select office that we probably would not be interested in anyway. We are seeing valuations that have been resetting over the last few years, so I think that explains, in particular, why some of the core plus strategies, and I know this is closed end only, we can talk about the open end piece, but that tide may be beginning to turn, but that's been challenging over the last couple of years. And so looking for higher return out of the real estate portfolio. And we have seen, I think a segment of the LP and investor universe increasingly shifting towards a total portfolio approach, where the capital, is deployed on each individual investment's marginal contribution to the total portfolio return and risk, rather than sort of an overall real estate allocation. And that may be one lever, because given, I think the richness in, at least currently, in public equity valuations and fixed income spreads continue to be tight. Real estate is one of the few scalable, real asset levers left, where some of those opportunistic type returns can matter meaningfully to the overall portfolio math.
You mentioned just sort of briefly the core open end space. Obviously, that's been an area that has struggled with fundraising valuations. It's been a lot of redemption queues. What is your outlook maybe for core open end capital flows in the year ahead?
I think I think there's still a question around, particularly in the core universe where some of the valuations sit. We are seeing improvement. I think we're getting, if you go to the latter half of last year, probably hearing more interest in that portion of the market than we have heard in years. And if you look at the Odyssey data, for example, Odyssey quarterly contributions more than doubled in 25 to about 3 billion a quarter, from about 1.4 in 23-24 on average. So that helped, I think, to begin to increase distributions as well, which are up to about 5 billion a quarter. And so the queue is still elevated, but it's beginning to fall. But I think we also see a pricing gap between transactions and valuations that continues to narrow, and Odyssey valuations were flat overall in 2025. So 4 quarters, basically almost identical from where they started the year, despite a lot of volatility in the macro environment. And so to the extent that signals, they've begun to hit the bottom and maybe the next step is up, that could begin to increase rescission activity in 2026. And I think this would really help on the capital raising front as well. If investors feel like new money can be deployed for new opportunities rather than paying off other investors who are in the queue.
Liz, anything you'd like to add on that?
The core open-end market isn't a perfect solution, but given its imperfections, I still think it's a very important part of investors that can only invest in private real estate. It does there's a big place for it in the portfolio. I mean, I think the past cycle proved, and this happens all the time, the perception of liquidity it's just a perception. When you need it, it might not be there. And then again, on the relative value, when you look across kind of the public REITs versus where the Odyssey is pricing today, there's a massive spread. However, many investors who sit in our shoes have a mandate of private real estate. They can't even actually invest in REITs. And so from a private real estate perspective, to buy some of the best assets in the country at maybe some rich valuations on a relative basis today, but have potentially a path to liquidity when needed or want it. There's definitely a home for that in the portfolio as a balancer. And, a lot of benchmarks we see are Odyssey oriented. And so, that does give you the stabilizer within your overall return targets. So, we're seeing money flow back into the groups, the have and have nots. The haves are getting the money again. Their redemption queues are down. And so, I do think select or the top performing core funds will have a great year.
I'm gonna take us into our final sort of key takeaways slide. I'm not going to go through every bullet, but I'll leave this up for a few minutes just for the audience to take a look. But I do want to sort of hit on a couple of things here. One is new fund launches. We saw over 50 new closed-end real estate funds launch in Q4. That was a big jump up from what we've seen in the previous quarters. So I do wonder if that might signal a bit of let's call it optimism in the market, or maybe just that other funds have sort of been able to finally, hit their sequencing, hold their closes, move on to the next in the cycle. Any sort of reactions on that sort of uptick in fund launches? Liz?
I think there is optimism. I do. So I'm not surprised by that.
And then I think the other thing I wanted to sort of touch on was maybe the sector-focused funds. We saw a big slice of the capital targeting residential in particular, $5 billion just to, things within the residential space, whether it's multifamily, affordable housing, just residential in general. What do you think, maybe taking a step back, what are you seeing on different sort of property sectors and their relative attractiveness? I might start with you on this one, Mark, with your research hat on, how do the different property sectors, whether they're sort of the main food groups or some of the more alternative niche ones, how are you looking at them right now?
Yeah, I mean, I think we've seen from a property sector perspective, obviously we've talked quite a bit about the data center space, so won't spend too much time on that, but I think that continues to have, a very strong macro story and supply-demand imbalance, and was one of the sectors that has been somewhat insulated from the headlines over the last 12 to 18 months. And so I think as we look forward to, some of the more traditional sectors, and maybe we'll focus on industrial and residential to start, but I think the industrial space and residential, I think investors are becoming more optimistic on the supply side for sure. They have faced record supply levels over the last couple of years, and so given how challenging it was to break ground going back to when interest rates began to increase because of debt costs and elevated land costs, I think we're expecting supply, and the third-party vendors would suggest supply is going to be down. New deliveries are going to be down about 70 to 75% in the industrial and residential spaces over the next couple of years. So that should, I think, provide some tailwinds to the overall fundamental picture. In the industrial space, a lot of tenants kind of put a pause on leasing activity in 25, I think, as a result of just uncertainty around the macro environment and trade policy, et cetera. I think we are beginning to see tenants become more, maybe it's just more comfortable with uncertainty, but we saw overall absorption and leasing activity pick up in Q4 of last year, and signs that that's continuing. And in our view, I think the fracturing of the global economy is on net going to provide the increased demand overall. And so that's something that I think we are looking at seeing improvement in 26, although there's still certainly some recent deliveries to work through. And I think similar story in the residential space. The supply story is improving significantly. That will, I think, help all markets. And we've seen a real divergence in the coast and the Midwest over the last couple of years. But I think those where the coastal Midwest markets didn't see the supply response coming in 22 and 23 and have really outperformed. So that lack of supply should disproportionately help some of those markets in the Sun Belt. But the flip side of that is what's happening with both immigration as well as elevated mortgage costs and a slowing labor market are putting some having impact on the demand side, right? So what's that going to do to overall migration activity, which is really what the Sun Belt depends on for growth. And so we have seen that activity slow quite a bit. And so I think, more and more, and just given where pricing has been the last couple of years, which is, in our view, continued to be pretty aggressive, particularly for residential. It's really how can you use that residential bucket. Maybe it's less about getting those opportunistic type returns and more about a strategy that can deliver durable income and that inflation protection at this point in the cycle.
Liz, anything to add from your perspective?
No, I mean, I think Mark did a great job of highlighting the supply in different pockets of the country, but just kind of very, very high level, we still like industrial, we still like multifamily. I think given a little bit of tariff noise, and the fact that the supply has gotten eaten up absorbed for the most part on multifamily, we might be leaning a little bit more towards multifamily today, especially where cost of debt is coming in too. So there's some tailwinds there, but we like both. And then retail, we're seeing that really pick up a lot too. We prefer keep it simple, grocery anchored, essential with, again, kind of improving cost of debt on that side could be really attractive. And then we also like, digitally enabling real estate. We like that, as I mentioned, with data centers and then some other of the niche asset classes too.
On the niche side, anything in the alternative sectors particularly jump out at you?
We like a lot of the fundamentals with senior housing. However, you have to work with the right operator. So that's a big focus of ours. And we're looking at self-storage again. There's a whole bunch of interesting strategies there that if you have the right operator who knows the segment well, it's definitely an area of focus for us to generate a little alpha.
Mm-hmm. I'm going to go ahead and end our presentation. Just for our last sort of 10 minutes, we can chat a little bit more. One question that I do have that we haven't really gotten into is the secondaries market. This presentation, we've been very focused on, new funds, closed-end fundraising. But what role are secondaries playing in the current investment market? Liz, start with you on this one.
We're very bullish within secondaries. I think the appeal, it has a number of appeals, but one of the biggest factors is you can underwrite something. A lot of what you're buying is pre-specified, so you're not taking on blind pool risk. And you can get comfortable with your own underwriting assumptions because we still see a wide range of underwriting assumptions out there. So you're stepping into something for the most part that's pre-specified. You're eliminating J curves, so that helps from an investment perspective. And I think in today's world, again, with a lot of external noise, if you can step into something that should get marked up pretty quickly, and that you feel comfortable with your own underwriting assumptions there, it's a good place in the market. I think from another perspective that we have, because we've done a lot within the evergreen space, is that, retail investors love secondaries too. And again, you understand, they don't get capital. They don't understand necessarily capital account balances and waiting, several years to become positive. With secondaries, you can jump in and have that positive return or markup right away. So that's a big appeal. And if they invest in a secondaries fund, you're usually getting like several managers behind it. So you get some of the large names at times. So across the board, we're pretty bullish on that space.
Mark, any thoughts on what you're seeing from your perspective?
I think Liz articulated very well. Secondaries are certainly having a moment in the sun right now. And, I think a big part of that from the institutional side, as Liz mentioned, right, is a divergence in underwriting perspective. So we've been, working with valuations as an industry here for the last couple of years. And so the more as the differentiation in forward-looking perspective diverges, that creates opportunities, I think, to transact. And probably some of the investors who have been locked up in some of those vehicles are either looking to, potentially some of them exit the real estate space, and it's an opportunity to get out. And some of them may be looking to reposition capital to where they see a better go forward opportunity. And so it's helpful from that perspective. And it's also helpful to as a way to, begin to add additional transparency in terms of pricing to the marketplace. So.
Also, just another anecdote on a relative basis, because we see the whole alt secondary market here. Real estate has the best, I think, most attractive entry point and potential for return. When we look at infrastructures, secondaries are pricing at par, sometimes even above par, given how hot that sector is. PE is pricing pretty tightly. And so real estate, you're still at around a 30% discount to NAV. Now, I think that's because, rewind 2 years ago, and we always joke, NAV was not asset value or not actual value. It was, who knows? So you had to have that steep discount in real estate because you wanted some cushion on where is the value meant to be. I think today we've gotten a much better sense for where our values are. We're seeing, when we look at our core portfolio, a lot of the funds that are trading assets are actually above where their NAVs are, which gives us a, pretty good indication that maybe NAV has caught up to, or appraisals have caught up to where real value should be and are lagging slightly, which is a good thing. And so when we look at the secondary space today, we actually think NAV means net asset value. And so if you're still at that 30% discount, that's a really good entry point. So if you're a secondaries buyer and you look at PE versus infra, and then you see real estate here, I just think that it's a really great play today.
I'm aware that we're getting close to the end of time, so maybe it might be time for us to just sort of give some final key sort of takeaways as we start to wrap up. Starting with you, Liz, let's start with you, and then I'll go to you, Mark. What are your key takeaways on real estate capital flows, the real estate fundraising environment, outlook for the year ahead?
Yeah, very optimistic for the year ahead. I think we're coming out of a cycle. We have generally a good balance between supply and demand in the country, in the US. And so fundamentals are strong. The debt markets are coming back, should provide more liquidity. And then I think with the unknown ahead in the world of AI, what does that mean? I still think real estate is a strong value proposition because these are hard assets. And I think should be able to withstand a little bit more of the AI storm potentially.
Mark?
Yeah, I would say we are pretty optimistic as well in the new year, though. To be certain, we were optimistic coming into 2025 as well, and that was a bit derailed. So, but yeah, I think all the factors mentioned, certainly increased liquidity in the debt markets, which tends to be a leading indicator of the transaction activity and pricing. And I think we see transaction volumes in the U.S. up 23% on a year-over-year basis. So improvements there, and that's something that we're seeing real time in the markets as well. And as Liz mentioned, and we talked about earlier, I think valuations are increasingly converging with transaction values, and we're getting increased. That pickup in transaction activity is helping to provide additional transparency and comfort around those valuations. And so, certainly from a investor interest perspective, we're seeing a significant pickup here in the last few months.
Well, I would just like to thank our entire audience for joining us. I would like to thank our panelists. Thank you so much for coming in and sharing your insights. I want to thank our IRE.IQ data services team, especially Nico Peppas and Director Karen Palma, as well as the rest of my colleagues for putting together this information. Just as a reminder, for those of you who came late, all the data discussed in this program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts, and it tracks more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Publication sponsors do receive access to IRE.IQ as part of their benefits package, but if you're not a sponsor interested in IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. The next IRE.IQ Fundraising Report Review webinar will cover first quarter fundraising, and that webinar will take place in May. Thank you all. Have a great day.